When I got my first real paycheck out of college, I thought I was rich. I remember opening my bank app, seeing that number, and instantly making a mental list. Nicer apartment, weekend trips, maybe even that shiny new car. But within 2 weeks, it was gone. Rent, bills, a few dinners out, and the dream was over until the next payday. That's when I realized something. I wasn't actually rich. I was dependent. My life was one missed paycheck away from panic. And here's the crazy part. Most Americans are living that exact same way, even the ones with good jobs and savings. Now imagine the opposite. Imagine you wake up every Monday, every Friday, and there's new money in your account. Not because you worked more hours, but because your money is out there working for you every single week. Most people think that's impossible unless you're a millionaire. They think dividends come every quarter, maybe monthly if you're lucky. But there's a hidden corner of the market, a handful of ETFs, that quietly pay out weekly. And some are so safe, they're literally backed by the US government. Others, they can yield 10%, 20%, even over 40% a year with all the trade-offs that come with it. This is not a get-rich-quick pitch. This is about freedom versus dependence, about building income streams that show up as reliably as your rent bill. I've spent weeks digging through fund documents, verifying every number, and stress testing them in different market scenarios. And today, I'm breaking down the 5 safest weekly dividend ETFs, from the ones that let you sleep like a baby to the ones that will make your pulse race. By the end, you'll know exactly which one could fit your portfolio and how to start collecting paychecks from the market every 7 days. Why weekly income matters for the modern investor. When most people talk about investing, they talk about net worth. That's fine on paper, but here's the uncomfortable truth. Your net worth doesn't pay your bills. Cash flow does. If you're 25 to 50, you're in what I call the pressure decade. You've got rent or a mortgage, maybe kids, maybe student loans, and you're trying to build a future without burning yourself out. The problem? Most investments pay you so far apart that you never feel the benefit in real life. Weekly income flips that script. Imagine you set up your portfolio so that every Friday you know exactly what's hitting your account. That changes your mindset. It makes investing real. You start connecting those payouts to actual things. This covers my utilities. This pays for my gym. This is my weekend budget. And for younger investors, that feedback loop is powerful. You don't have to wait years to feel the payoff from good financial decisions. You see it every 7 days, and that keeps you consistent, which is the real secret to compounding wealth. ETF number 1, week, the ultra-safe Treasury bill. Let's start at the safest end of the spectrum, the Roundhill Weekly T-bill ETF, ticker WEAK. If safety was a person, it'd be this fund. Here's what it does. Week invests exclusively in U.S. Treasury bills that mature within 0 to 3 months. When one matures, it immediately rolls into a new one. Think of it as a rotating ladder. Every rung pays out right on schedule. That's what creates your weekly dividends. The yield right now? About 1.72%. Yeah, that's not going to make headlines. But here's the trade-off. You're essentially holding the safest investment on the planet. It's backed by the full faith and credit of the U.S. government. If that fails, your ETF is the least of your problems. Who's it for? If you're ultra-conservative, maybe retired, or just parking cash between bigger investments, Week lets you earn something while keeping risk close to zero. You're not gambling here. You're getting paid to wait. ETF number 2, MMKT, the heated safety blanket. If Week is your basic safety blanket, MMKT, the Texas Capital Government Money Market ETF, is the same thing with a built-in heater. It still plays in the safe zone, but with a little more yield. Here's the setup. MMKT invests at least 99.5% in government securities, repurchase agreements, and cash. And it follows strict SEC Rule 2-7 compliance. That means its average maturity stays under 60 days, which keeps risk very low. The current 30-day SEC yield? 4.89%, more than 6 times higher than Week. That's the difference between I barely notice it and this is paying for a couple dinners out each month. It's perfect for anyone sitting on a chunk of cash earning next to nothing in a savings account. You still get government-level safety, but you're paid weekly instead of waiting for quarterly payouts or monthly interest. In other words, MMKT is where cautious investors go when they still want their money to feel productive. ETF number 3, BRKW, Buffett's weekly paycheck. If you've ever wished Warren Buffett would cut you a check every week, BRKW, the Roundhill Berkshire Hathaway weekly pay ETF, is about as close as it gets. Here's the twist. Berkshire Hathaway has never paid a dividend in its history. Buffett reinvests every dollar back into businesses. But BRKW uses a clever approach. It holds Berkshire Class B shares, adds a modest 1.2x leverage, and then sells covered calls to generate income. That combination turns Buffett's empire into a cash flow machine that pays you weekly. The distribution rate is around 3.02%. But remember, you're not buying some speculative stock here. You're getting exposure to a portfolio built by one of the most disciplined investors of all time. The modest leverage boosts returns without going into dangerous territory. It's a great fit if you admire Buffett's long-term approach, but want to actually see the cash hit your account regularly. Just keep in mind, at $4.2 million in assets, it's still a small fund, so liquidity might be thinner than the giants. ETF number 4, SDTY, the high-yield 0DTE machine. Now we move from steady to spicy. SDTY, the YieldMax S&P 500 0DTE, covered call ETF, is what I call Wall Street's daily hustle in a weekly paycheck. The strategy? Every single trading day, SDTY sells call options on the S&P 500 that expire that same day, 0 days to expiration. They collect premiums from traders making short-term bets, and those premiums get pooled into your weekly payout. The result? A jaw-dropping 23.69% annual distribution rate. But here's the reality check. About 51.6% of that payout is return of capital. In plain English, part of what you're earning is your own money being sent back to you over time. That doesn't make it bad. It's just a trade-off. You're choosing high current income over long-term capital growth. If you want your portfolio to throw off serious cash now and you understand the mechanics, SDTY can deliver, but it's not a set it and forget it forever hold. ETF number 5, GLDY, gold meets weekly cash flow. Finally, we hit the heavyweight champion of yield, GLDY, the Defiance Gold Enhanced Options Income ETF. Current annual distribution rate, 41.74%. Yes, you heard that right. GLDY sells put options on the SPDR Gold Trust, the most popular gold ETF, while holding cash and treasury bills as collateral. If gold stays above the strike price, GLDY pockets the premium. If gold falls and the options are exercised, they buy gold, giving you a hedge against inflation. But here's the big caveat. 93.4% of those payouts are return of capital. That means most of what you receive isn't pure profit. It's your original investment being distributed back to you in a structured way. So why even consider it? Because for income-focused investors who want maximum cash flow now, GLDY can be part of a diversified approach. You're mixing potential gold exposure with weekly paychecks. Just be clear on the risk. You're trading long-term compounding for high present-day income. Risk and reward, matching ETFs to your risk profile. Weekly dividends sound amazing, and they are, but the smartest investors match their investments to their risk profile. This is where people either build a solid portfolio or end up chasing returns they don't understand. On one end, you've got weak and MMKT, the safety plays. They won't make you rich overnight, but they protect your capital and pay you like clockwork. These are perfect for ultra-conservative investors or as a safe zone in a broader portfolio. In the middle, there's BRKW, Buffett's philosophy with a twist. Quality assets, a touch of leverage, and steady payouts. Good for moderate investors who want some growth with their income. Then you've got SDTY and GLDY, the high-yield powerhouses. They can generate incredible cash flow, but much of that is return of capital. And the strategies carry more moving parts and potential volatility. These work best for people who understand the trade-off between current income and long-term growth. The bottom line? There's no best ETF for everyone. The best one is the one that fits your goals, your risk tolerance, and your timeline. Action steps. How to start your weekly dividend journey. If you're ready to start building weekly income, here's the game plan. Step 1. Define your goal. Is it maximum safety, maximum income, or a balanced approach? That will determine which ETFs even make sense for you. Step 2. Start small. You don't need to put your entire portfolio into these funds right away. Pick 1 or 2 that fit your profile and track how they perform over the next few months. Step 3. Automate your process. Set up recurring investments so your weekly payouts start to snowball without you constantly thinking about it. Step 4. Reinvest strategically. If you don't need the income immediately, consider reinvesting it into more shares to compound your future payouts. Step 5. Review quarterly. The market changes, yields change, and your life changes. Adjust your ETF mix as needed. Building financial freedom 1 week at a time. Here's the truth. Financial freedom isn't built in giant lottery moments. Hey, it's built in small, consistent wins that stack up over time. And that's exactly what weekly dividends give you. A steady, predictable way to turn investing from an abstract concept into something that actually supports your life. I've seen people use weekly dividends to cover their groceries, pay for their kids' sports, or knock down debt faster than they thought possible. For me, it's not just about the money hitting your account. It's about what it represents: control, stability, and momentum towards your dividend hustle. So whether you start with the rock-solid safety of week, the balanced approach of BRKW, or the high-octane cash flow of GLDY, the point is to start. One decision today could be the first step toward a life where your investments pay you every single week. I'm Mark. This is Dividend Hustle. And if you found value in this breakdown, subscribe and join me next time. Because your goals aren't just dreams, they're plans in progress.